Welcome to The Real Market with Chris Rising, the only podcast that brings the real estate conference panel to your headphones. You'll hear from superstars from every realm of commercial real estate, the biggest brokers, the most well-known architects, the largest investors, and the most visionary developers. We'll learn what they do, how they do it, and what drives their success. We'll discuss the latest trends across regional markets, capital flows, both national and global, and we'll explore technology's role in shaping all of them. We'll take a clear-eyed look at where we've been, where we are now, and what's to come. Real conversations, real experts, real insights. This is The Real Market. Welcome to The Real Market. Excited to have Geoff Arrobio here with me today. Geoff is with Matthews Real Estate Investment Services. He's been in the business for quite a long time. He and I have known each other for even longer. I don't think I want to admit how long, but we both didn't have any gray in our hair, and we actually probably had 70s perms going at the time, I think.
Pretty close to it, yeah.
We've been friends a long time, and I've watched Geoff's career going from when he started at Community Bank, I think it was, in Pasadena, working his way through several gigs and several cycles. So, Geoff, welcome to The Real Market.
I really appreciate the time and glad to be here. And let's talk about some real estate and some other aspects of what's going on in today's market. Look forward to it.
Oh, great. Well, let's start with, because Matthews is a rather new name on the scene here. I mean, a lot of people are familiar with the old Johnson Capital and obviously Walker Dunlop, but there are other names out there that are competitors like JLL or Marcus and Millichap. Why don't you tell us a little bit? I mean, I think what most people know about Matthews is that Kyle Matthews is very aggressive in his marketing and his podcast and things like that. But I don't know if anybody in the world of my audience really knows the capabilities of Matthews. So why don't you start? Why don't we start there?
No problem. Be happy to. So Matthews was started by Kyle in 2015 out of El Segundo, and Kyle used to work for Marcus and Millichap. And he branched out and started his own firm called Matthews Real Estate Investment Services, primarily as a broker for the sales side. So representing clients for sales, be it multifamily or retail or industrial, et cetera. And since 2015, he's been on a tear, building out his platform nationwide. And so there are 19 offices nationwide currently, coast to coast, over 600 brokers. He added the mortgage banking side or capital market side, if you will, to Matthews about 2 years ago. Cliff Carnes was put in charge to develop that platform to assist in two ways. One is to assist the sales side of the business to put together acquisition financing or refinancing structures for clients, and then to also build out some legacy financing structures, be it on the tailoring to construction needs for clients on all asset classes, bridge financing, permanent financing. So we're really building out the capital market side of the business and touching all the major real estate groups out there, real estate asset classes out there. And we're about 25 people so far, and we're looking for good talent and hard charging people that can use the technology within the firm and leverage that with the relationships that they're creating as they move forward in this marketplace. So they do about $3 to $4 billion in sales. I think probably a little bit more than that. Again, I'm on the capital market side, so not really in tune as to how much they're actually doing, but they do quite a bit of business. Their market segment is, between $2 million up to about $30 to $40 million. So more of the smaller mid-market sizes. That platform is going to grow over time. We're trying to reinvest into the company in terms of reinvesting in the people and technology to in this period of time to capture additional talented people to build out the platform and grow during a tough time in the marketplace. So,
well, I would say I had a brief chance to meet Kyle recently, and he certainly brings a presence. He seems like a very strong leader. But what I was really impressed with was the people he had around him who were on his team. I mean, quite frankly, it kind of reminded me of the old Cushman days, where these are just hard charging, work your tail off kind of people. And so I was pretty impressed. He did say that the focus right now is in a bad market, it's a good time to give people an opportunity. And on the capital market side, he said that's something that they're very focused on, and asked me for some names and all, but he was really proud that you had joined him. And I think with you there and some of the people he's put together, I think it's a real opportunity to grow.
Yeah, I mean, one of the only gray hair guys, I guess, in the firm. Which lends itself to a lot of questions. I do get asked a lot of questions from some of the younger folk, and part of the whole culture is to teach some of the younger brokers how the business works, not only based on lender knowledge, underwriting knowledge, but relationships. A lot of some of the younger guys are coming out of college. They go through a Matthews University, which is pretty interesting. As you said, kind of what Cushman used to do back in the day. Coat and tie, black shoes, looking good, learning how to really communicate over the phone or through Zoom. Go to meetings face to face, which is really important, especially in this business. It's still a relationship business. And then teaching them how to really do the blocking and tackling of this business, which is understanding your market, understanding your asset class, and underwriting, and then executing. So it's been kind of a breath of fresh air coming from some major firms out there to more of an entrepreneurial firm. Where I can actually touch base with a lot of different, not only brokers, but asset classes. And I have experience in all of them, which was great. And I don't specialize in just one asset class. I do all the asset classes from soup to nuts when it comes to construction, all the way through the life cycle, permanent financing or sale. So it's kind of a fun, hard charging group and a lot of energy, and it's been great so far.
So on that kind of $2 to $20 or $2 to $40 million sale, there's a lot there that would fall into Fannie and Freddie, HUD, all that kind of stuff. Is Matthews licensed, can do all those kind of deals, or where are you guys in the cycle of doing that?
So we're not licensed yet. That does take some time to do. We are aligned with agencies, agency DOS sources, and Freddie Mac seller servicers on a direct basis. So if there are agency business that comes in or multifamily deals that come in, we can execute either on the agency side, the life insurance company side. We're really building out our life insurance company correspondency systems and servicing. That's something that we're building out currently with the likes of Symetra and Stancor, and Meritas, and some of the other small life insurance companies. Whereas some of the larger life insurance companies are kind of open to everybody. But for SBL, for Fannie Freddie SBL, we have direct sources too, which doesn't add cost actually to the transaction. And then for larger nameplate Fannie and Freddie deals, or even HUD, we have that execution ability as well. So it's pretty seamless, and we have good execution on those fronts. So yeah.
So what I find interesting about what you and Kyle and the team are trying to do, is obviously there's a desire just to be successful and build things, but I really got the sense that there's a desire to build a culture that is about succeeding. It's not about trying to be everything to everybody. It's not trying to make sure, we've got this program going here and that program for culture. And it's about, hey, we represent clients. And right now, it's really hard to get debt. So and it's not just for the buyers. The sellers want to know that if you're going to bring them a buyer, that you're able to get them debt. Correct. So when you're looking today at what you think is a competitive advantage for Matthews, if you're partnering with a go-get-them kind of sales broker, give everybody the pitch. And I want two pitches. One, the first is to the client of why they should be hired. And the second is to the young talent out there, why you guys are doing it different.
Well, I think what we do as a firm on the capital market side is really clear the market, right? So if there's a multifamily deal that it's in Southern California that's for sale, we will analyze that deal up front and make sure we look at all the aspects of it, from current rents, pro formas, and so forth, and expenses, and clear that market. Meaning, we will make sure that we touch base to every lending source out there that's currently in the market. A lot of them are not in the market, but obviously the agency sources, the life insurance companies, the credit unions, and so forth, and give them basically a menu of options with regards to how that deal can be executed. So it's really knowing your asset class, but also your lending sources, and we can definitely do that. For the young, hard charging guys out there, they do work. We do work extremely hard. I mean, kids come in, fresh. Some of them are fresh out of college, go through the Matthews University process, and you have to have good work ethic when you work here. Some of these kids are coming in even during the weekends and really learning the business. Some of them are making 500 calls a week, so they get to learn how to communicate, but also you get knocked down a couple notches, and that's not a bad thing. And that builds character. It builds tenacity, and that's what Kyle's really looking for, is people that don't mind getting knocked down. We all played football. You played football. I did too. And so did Kyle. Getting knocked down and getting yourself back up is part of character, and not getting too disgruntled, and knowing that, hey, if I keep doing this long enough, that there is going to be light at the end of the tunnel, and I'm going to create those relationships, be it with lending sources and with clients. So that's, I think, embedded into this company, is that, hey, if you get knocked down, get right back up, get back on that horse, and keep going, because at the end of the day, you're going to find those successes if you have that tenacity. So,
and as tough as things are, this is when the opportunity for the new shop, right? Because somebody hires CB, and I've always hired CB, and now CB can't execute. And I'm not trying to slam CB or JLL. I'm just saying this is the time when there's a fracture in relationships because it's tough, and it doesn't have to be younger. I don't mean that, but I mean a new view on how you get things done. But to me, it's opportunity. And I guess you and I have been through, I think this is our third full one, maybe our fourth, since we kind of knew what real estate was.
Right.
And it's the people who just keep fighting and don't give up, who come back. And then when the cycle is good, make a good amount of money, and cycle's bad, they've earned their spurs, and they're getting through it.
This is a long game. This is not a short game. I mean, I think, for the younger brokers out there who are interested in this business, you have to think of it as a long-term game. You can't think of it as, hey, I would need to make my next commission, and I'm going to do shortcuts and just to get this deal done and move on. That's how you lose relationships. That's not how you garner relationships. And those who are actually being advisors to clients, even if it may be a transaction that doesn't make sense, and you say, you know what, this is probably not your best interest at this point in time. Let's wait for a better day. That's advice, and that garners trust with you and your client, that you're giving them. You have their best interest in mind. It's not just transactional. So, and that, I think, gets lost in this business a lot, where it's just, I got to make money, got to make money, got to make money. Whereas, no, you need to be an advisor first, and know what your end users' goals are. You got to keep their goals in your mind, and add value to that, right? Any way you can with your knowledge and the market knowledge and lending knowledge and deal structure. And this takes time. It doesn't happen overnight. And so patience, long game, and always learning. I mean, you can always be learning something, picking up periodicals, understanding economics and the reasons why things are happening. So you have that knowledge, and you can pass it on to your client base. And I think that's very important in this marketplace, to have that kind of.
I know on the sales side, Kyle talks a lot about technology. On the capital market side, you guys, it's more of a relationship. You can't just use some technology and all of a sudden you've got an insurance company who's ready to make a loan. But when you look at what Matthews on a day-to-day basis, what its culture is, it's looking sharp, that's for sure. I mean, Kyle always looks like $1 million when he's out there. But it's also like, what is it for a young person that would they would gravitate towards on a day-to-day basis that maybe some of the older, stodgier, bigger international firms don't have?
Well, I think when you walk into a Matthews office, it kind of takes me back to I used to work at Bear Stearns right out of college on a trading floor. And Matthews has that kind of similar vibe where there's a lot of I don't call it water cooler talk, I guess you'd say, but it's open. So there's a lot of collaboration between the older people, seasoned veterans, I guess you'd say, and the younger groups. So doors are always open. It's very collaborative, and there's a lot of energy within each office, which is really cool. You go into kind of your some of the existing companies that everyone has their door closed, right? So that's not the vibe here at all. It's very collaborative. There's no dumb question. And if you don't know something, ask someone who knows it, right? So we're very open, and lending sources are an open commodity within our firm. So we share the knowledge, if you will, back and forth, who's doing what, how, why, and when. And on the sales side, it's the same thing. Like, hey, you're working on this type of asset class. How would I structure this? And so they're always learning, which is great because it's very collaborative.
That's great.
Yeah. So I think that is fantastic. Yeah.
But I say this out of admiration. It's not a place where you're just going to work 38 hours a week and have any success. It is a place. And the bottom line is, if you want to make wealth in your life, that's the reality.
You got to put the time in. You got to put the time in. Everything you got to earn your chops. I mean, I've said that for years, and it's a slow process. It takes time, but once you get over that hump and you put in your, couple thousand hours, right, and you start understanding the full picture of how things actually work and are structured, and then you start seeing success, and then you just want to capitalize on that and keep going. So it's a fun firm, high energy, smart guys, go-getters, and I'm happy to be a part of it.
Terrific. Well, let's get into the real meat here. I'm going to set up talking about where we are in the market today at a story I heard 2 days ago at a YPO real estate roundtable. A friend of ours, mutual friend of ours, was telling the group that he owns entitled dirt in a major industrial market.
Mm-hmm.
Got a 10-year lease from a company that everybody here would know who it is, and knows the global credit and all of that.
Okay.
Cannot get financing that the lease would pay for. He would lose money because the lease rate's the lease rate. He said he's getting quoted to build a manufacturing kind of industrial building anywhere from 9.5 to 10.8% on a construction loan.
Yep.
And you just go, what world are we living in when a credit tenant with somebody who owns the land free and clear with entitlements, and all they need is the construction loan to get this thing built and bring all these jobs, and it's just where the world is right now in October 25th, 2023, it's not feasible. What is going on in the world?
Well, I'm having a lot of those conversations with clients today, and in this case, it's industrial. I'm having the same conversations on multifamily and other asset classes. Well, what you have currently is obviously the Fed has raised rates, 500 basis points, 500 basis points over the last couple of quarters, and has really backed up what we use for our index for pricing construction financing, which is either SOFR or prime rate, right? So, since we've had SVB and Signature Bank go under, or taken under, if you will, there's
Yeah.
been
The run.
yeah,
The
exactly.
digital run on the bank with Peter Thiel telling all his friends to get your money out of
Right.
SPV.
So you've had, and we can get into that if you want as well, and the reasons why. But you've had a big backup in construction lending in terms of its cost. And with that, not only the cost of that, the price of that capital has gone way up. The underwriting to that capital with regards to loan to cost, depository relationships, because most banks are going to want deposits now on a construction loan. At least 10 to 20% of the construction loan needs to be in deposits.
Yep.
Global cash flows are tantamount. All the lenders are looking at their global cash flows, obviously creditworthiness and so forth. You're having a lot of people put pencils down because it just doesn't underwrite. And they're either putting pencils down and waiting for the next couple quarters to see where things shake out. Or the alternative is to go to private debt funds. Now, the cost of private debt funds are going to be somewhat similar in terms of its pricing, maybe a little bit more. But I think the advantage that they have is since they're not a non-regulated fund or funds, they can get a little bit higher on the leverage scale. So rather than a typical bank is going to be in the 55 to maybe 65% loan to cost in the higher end. It's for your type of deal, potentially, not knowing what the credit is. But a debt fund may be able to push that leverage up to, another 5 to 10% potentially. But that cost is going to be relatively the same, a little bit more. So, and that's just the world we live in right now until things.
You wonder if lenders start saying, "Hey, I'll do it at something that makes sense if you give me a participation or something."
Yeah,
are we really in that world?
You also have on the fixed rate side of things, you do have a lot of institutions did this in the first couple quarters, where they're coming out of floating rate debt and they wanted to fix it, and they basically done a lot of rate buy down. So
yeah, we've done that.
They pay a couple points, and instead of borrowing at a 7% coupon, they're back down in the low sixes, which makes the cash flow work on a debt service basis, and they can get the person.
And we just looked at it as though we're just using more equity.
Yeah, exactly.
We're just instead of it being 60% LTV, it's a 52, and that 8% is buying us a lower rate.
Right, and over the long run, you make it back up, right? And so it's not a bad way to look at it. Now, we're still in a rising interest rate environment, and I don't.
Well, I would argue the 10-year being where it is, what's gone down a little bit, but above 5 is as though they added 50 more bips to the Fed funds rate.
Yeah,
I mean, it's got the same effect.
Yes, it does. And spreads, when you chop up the market, at least this is what I do in my mind, is that you've got spreads for construction, you have spreads for permanent financing, and in the permanent financing world, you've got life insurance company spreads, you've got credit union, if you will, spreads, bank spreads, and then CMBS. And the CMBS side is completely blown out. And the life insurance company side on perm financing is the most competitive so far. But again, they're going to be pretty conservative in their underwriting and still going to require, some not depository relationships at all, but credit worthiness of that client and that credit to garner those spreads. So,
well, I interrupt real quick because one thing about with the insurance companies is we are at October 25th. And so a lot of these insurance companies are pretty near their allocation. They've already done it. So it's a lot easier for them to say, hey, we're out of the market for 2 months and we'll see you in January.
Well, a lot of them will sign up deals today for execution next
year. But I'm talking about to try to close something by year end.
Yeah. And most life insurance companies get new allocations, the end of January, beginning of February. And I've had those conversations with a couple different groups so far, actually this week, and they're not quite sure where they're going to be. But there's going to be, they're going to be in the marketplace because they need to offset their liabilities with assets and so forth with commercial real estate debt. So that will occur, but the underwriting has become extremely tough, especially for the office sector, which is its own anomaly currently, an issue. And a lot of life insurance companies are just saying, we don't ever want to see an office, even medical office. Some of them are saying, hey, it goes against our current credit format, and we can't even do a credit medical office deal.
Wow.
Which is
because they're actually going back. They're back to work. People are going to see the dentist and the doctor.
Yeah.
That even can't get financed.
So that asset class, as an asset class, I think medical of all office product, I think it's fared extremely well. Those medical tenants pay their rent on time. And if you've been into a medical office lately, they're always packed. There's people that need those services. I think that is one of the better asset classes out there, rather than downtown CBD or maybe suburban, but the MOBs have done pretty well. So
let's take this in another direction. Just talking about why we're here. There's the kind of Bill Ackman, Ray Dalio point of view that we have an inverted curve because we have profligate spending by both parties. We're at $2 trillion in excess debt this year, just on our fiscal budget year for the federal government. And because of that largesse, we're going to see interest rates high for a long time. There's another group of people out there who feel like interest rates are going to start coming down on the next event. Like, Israel Hamas was just the beginning. We're going to have a few more of these, and the world's going to panic and interest rates are going to come down. Obviously, you don't really, for your business, it doesn't matter where they are, you're going to get the best deal for your client. But personally, which camp do you get in? Do you think we're going to have lower interest rates in the next year or two, or we're going to be longer forever or higher forever?
That's a really good question. And let me try to answer that. I'm in the camp where it's very difficult for the government at 120% of debt to GDP to lower rates, unless you're really going to start the money printer again. And that may be what happens at the end of the day. What triggers that money printing event? Everyone wants lower rates, right? But what triggers that money printing event is either a black swan event or some major breakage. I think, I don't really think it's more of an inflationary component today. I think it's more of a fiscal policy issue today, where we have so much debt that it's very difficult to service. If you look at, our GDP, third of it is going to interest payments, and then you've got Medicare, and then you have defense. So a lot of that is taken up already, and then you have every other program after that. So I think the Fed is in a box. That's the kind of camp I'm in, and I don't believe in the complete soft landing metaphor or talk. I think there's going to be some reckoning here. We've had free money for 10 years. And now we're at 5%. And if you look at 15 years ago, 5% is normal, right? I think 0% was unnormal and an anomaly, but we had it for so long. And so you have clients that are based on that 0%, which we're probably not going to go back to unless there's major some issues here where they have to do some emergency cutting. Does that affect the long end of the bond, even if they do cut immediately? I don't think it really does. I think that the treasuries, because of the leverage they have currently and the outstanding paper they have to refinance over time, is going to stay kind of close to where it is. Maybe it goes down to a 4 or whatever during a black swan event. But I also think that my concern going forward is a liquidity event, meaning we do have all this debt that needs to be repriced. You've got junk bonds that need to be repriced, corporates, and then you've got treasury. That's a lot of paper to refinance over the next 18 months. And that's going to soak up a lot of liquidity. And that's more my concern, is liquidity issues, than it is, of course, the deficit is another issue, but I think that's where things are going to get either interesting, I'd say the least.
Yeah.
And then the other side of that is, the additional point of that is that the CRE debt. I mean, you have banks that are holding on a lot of CRE debt currently. And the regulators have come into most of these institutions and basically said, listen, I was actually reading it yesterday. The Treasury put out a bulletin yesterday with regards to, lend and extend on troubled notes. And I think that has a finite life to it, meaning I think by summer of next year, you're going to see some of that paper unravel and come to market. I don't think the big banks don't want to be the first ones out there and put their toe in the water and say, hey, we're going to make the market here. And because that would adjust everyone else's book. And so that's why they're doing the lend and extend kind of programming. But I think that will come to fruition sometime next year, which is going to create opportunity. I mean, volatility creates opportunity.
I agree, but I think it's going to be such a massive issue that we're going to have another TARP or something like that. We're going to have the government partner with private, and that means the Blackstones and the Oaktrees are going to make all the money.
Right.
But I just think it's going to be so massive that because the reality is reality. I just read that Blackstone is defaulting on Howard Hughes Center, and they've been getting ready for that for 3 years. Who's going to buy that right now? I mean, if you don't have some government incentive to take that out, I think it sits for a long time. I mean, there always is a market clearing price, but do you want the market clearing price close to zero? Because that will then have. So I wish I could be an optimist on anything around office, but we're going through a cultural change. I think it's going to work itself out. And I had lunch with Bill McMorrow, and I thought he had a good analogy. He goes, everybody wants to make it like 92, and it rhymes with 92, 92, 93, and maybe from 88 to 92, 93. He goes, but in his eyes, we have to think about this between COVID, the high interest rates, and now what we're probably going to have a recession is kind of like World War II. I mean, you've got to be ready that this whole thing, we're kind of 3 full years into it. It's probably 5. So we probably have 2 more to go before we're through this.
Yeah.
And it's a little humbling. But as we said at the beginning of the show, if you're young and you're hungry, or if you're old and you're hungry, there's a lot of opportunity, because there will be market clearing prices. And
right.
That will be. And then we'll figure out this culture on office. I think it's just, we had such an explosion in technology, and you had older people adopting it, and it really worked for them. Zoom really worked. If you're a 55-year-old partner, I can work from home. We're going to work our way through that. I think the reality is going to be some sort of hybrid, because things you and I that we could only do in the office,
right?
We'd go in on Saturday and Sunday, because that's, we started right when desktop started, but that's where our big files were. So it's pretty ridiculous to say to a young person, come into the office, just to come to the office on a Saturday, but it doesn't mean they're not going to be working from home, and I think technology, and I know that the sales side, you guys really use this, but we see it on our side too. Technology allows for effective communication if it's done properly. But the kids all think you can email the CEO and they're somehow going to respond. So they got to learn that, no, you got to find other ways. So I thought Bill hit it right. I think we all want it to be a 3-year lull, and it's really going to be 5 to 7 years. And people who can stay aggressive are going to make some money.
Yeah. And if they have liquidity, I think cash is going to be king of the next couple years. And deployed correctly, right? And making those, and that's where we come in, is helping them make those decisions on the financing side and the sales side, and the long-term outlook of how that asset's reacting in that market, and where the demand is, and or no demand and absorption, et cetera. So there's a lot of nuance to this business, and you're going to learn. A lot of the younger guys are going to learn a ton in a down market and how things really work, and they're going to see the good, bad, and the ugly. But then once you do come out of it, it's going to be fun to see. Of course, things are going to change, like you say. Maybe the CBD changes in terms of how it's utilized, or occupancy, or conversion, or whatever the case may be. It's exciting times and to see that, but there's going to be some pain. I mean, I just want to be honest. There's going to be pain, but that pain lends to opportunity for savvy investors who have their sights on certain asset classes, that they have the management experience, they have the lease up experience, they understand those markets, and they're willing to play the long game and see where things go. I think they'll do very, very well. So
let's walk through an example. I'm going to put you on your toes here, but I know you'll be able to answer it. But if I want younger people to understand what it is, the service that you really provide. So let's say I came to you and said, Geoff, I own this apartment building. Fortunately, I bought it with about 65% equity. So I only have a 35% loan. But boy, I didn't fix it. And interest rates have gone up. And I put so much equity because I really want this to be something for my kids one day. I'm not getting the rents I thought I was going to get, but I want to restructure this. And I want to structure it in such a way I'm willing to put a little more equity in, but I want to know that I can rely on where my interest rate's going to be for 7 to 10 years. Okay. How would you solve that problem?
So it's our business is math. I mean, it comes down to mathematical equations. So I would look at the rent roll, your operating statements, pro forma out where your current NOI is. If you're going to be putting in additional capital to raise rents, that needs to be taken into account. So we would obviously analyze, the timing of that renovation, what your pro forma rents would look like after renovation if you're going to have some turnover. And then we figure out, okay, this is your stabilized NOI at year X, whatever X is, call it 12 months, 6 months, 8 months, 12 months, whatever. But if you're looking for current fixed rate financing today, we're going to go out and clear that market and figure out what's the cheapest source of capital for a 35 or 40% loan to value loan, but it's going to be on the math side. So we're going to take your NOI, we're going to divide it by whatever underwriting debt service coverage ratios are out there. Now they change. Some lenders are a little more aggressive. Some can get down to 115, 120. Others are going to be like the agencies that they're going to stay at a 125. And then we're going to use, the current market rates at, between the high 6s and low 7s on a 30-year schedule, and figure out what your loan constant is to calculate your loan amount. So, we can, to figure out the best source of that capital, for a lower leverage deal, I already have in my mind kind of where I'd go with that, and it'd probably be either local banks who can get to that 120, 115 debt service coverage ratio, but then you're going to have to potentially be partial recourse or recourse to that for a certain period of time, call it a 5-year term, or alternative is a small life insurance company that doesn't have that exposure of that asset class in this marketplace, and they're looking for it where we can execute it on a great rate, maybe a couple of years interest only on a 30-year schedule thereafter. But if there's a nuance that you are doing some value add, that kind of changes the conversation a bit, because that's more of a bridge type financing, and that's much more expensive than the fixed rate stuff. So you really have to have, as an investor, your ducks in a row. Like, where do I want fixed rate here today and take the cash flow and not do the renovations? Because if you do renovations and you have mechanics liens on it, you can't really do a fixed rate deal today at the levels that you're requesting, right? At the lowest possible rate. That's more of a bridge type of financing structure. Now, there are structures out there that you can do a bridge that flows into a permanent rate down the line. You fix it after a certain period of time. That could be another way to look at it and structure that deal.
Let me throw one wrinkle in here so we can understand how you look at it.
Yeah.
What would be the difference if I told you that apartment complex is sitting in the city of Los Angeles versus the city of Nashville? What kind of improvement would you get in your loan just based on landlord or tenant friendly laws?
Again, if you're in LA County and you have rent control on it, obviously you have some caps as to what you can do on your rent growth. Is that going to change the pricing of your capital? Probably not that much. The only way it would change pricing and capital would be if it was truly an asset that was below a certain AMI. So,
just make sure everyone knows what an AMI is.
It's your average monthly income index for that particular zip code or area code for your tenant base. So it really is a designation between an affordable asset and more of a market rate asset. So on the affordable side of the asset class, if it is a property that has certain AMI restrictions, not restrictions per se, you can have restrictions either through Allura or HUD Section 8. But if it's within an affordability context and you have a certain percentage of the units that are affordable, it lends itself to a better pricing through the agency side, because that's called mission business. The Freddies and the Fannies of the world have a very high target rate for affordable housing. And so if that asset meets those metrics, then yes, you can get better pricing through the agencies. Maybe 15, 20 basis points on those types of deals. Now, if you're in Nashville and it's a strictly market rate deal, but you've got rent growth that will happen in the future, and you don't have really a major cap to that like affordable housing does or LA County does. Is that going to change your rate per se at the end of the day? Probably not. It's going to be pretty agnostic with regards to what pricing will be, again, unless it was an affordable housing type of project in Nashville. So I don't see a big divergence in rates from market rate comparatively to Nashville to Los Angeles, unless you throw that affordable component in.
Yeah, that makes sense. Well, I appreciate it. That was, we didn't plan that in advance, so you were good on your toes there.
Oh, no worries.
Well, we've been going for a bit here, but I think what's important is you've got a lot of experience in the business. For those people who don't know, Geoff's got 2 kids. One's William and Mary. She's doing great there, I hear. And then your son's a senior in high school. So you've had a career over 30 years. You've got a lovely wife. You kind of, if you're 25 years old, someone looks at you and goes, well, that's where I want to get. What are the lessons learned for you, having really cut your teeth in the early 90s? We went through that recession, and then we had the tech wreck, and we had the GFC, and now someone will come up with a great name for where we are now. But what are some core principles that you think have led to your success, both as a business person, but as a father and a husband and a leader in the real estate industry?
I think education and being very well read is very important. It helps with the communication skills all across the spectrum, and putting concise thoughts together and intelligent thoughts together. I think being very well read, not only on the economic side, but your market side, and even stuff that's outside your purview. If it's energy, if it's being philanthropic. I mean, those are really important, and to be well read on things that interest you. So I think reading everything, always studying markets and studying economics or things that are interest to you, and learning new things is important. So that's where the education comes in. Long-term relationships in this business is extremely important. It's still a people business, and I would not have gone where I was 20 years ago or 30 years ago to today without those long-term relationships. And that took time. Was I cold calling and dialing for clients on the phone? Absolutely. And that is a very important part of this process, is learning how to communicate, getting in the door, making a pitch, meeting with the CEO or that investor face to face through coffee or a meeting or whatever. Those relationships will last for quite a long time and will pay you dividends in the future if you can establish those relationships. But it's also performance. You have to know your market. You have to know what you're selling, and be very knowledgeable. So that's the other part of that comes into play for a long, sustainable career in this business. And then you have to have thick skin. I mean, you really have to be able to take constructive criticism, a lot of no's, and think on your feet and not take it personally. I think this current generation that we're seeing come out of college is a little bit different than you and I. They're a little more sensitive. They want everything, yesterday. That's not how this works. You still need to keep learning, pay your dues a little bit or a lot of it in some cases, and stick with it. And at the end of the day, you can build a really fun career with these long-term relationships with clients that you're actually helping build their wealth and their asset base, and at the same time you're building your own. So it goes both ways, right? So
the only thing I would add, because I watched you have it in your career, is that I think the importance of having mentors. This generation needs to understand that, because we've been in this business. My dad used to say that, I've been around long enough to see something that was never going to happen again and again and again. And I think when, I'm doing business with someone, they don't have to have been through 3 cycles, but they have to have access to people who have. And I think there's just not enough. There's too much of this. I'm really fast on the computer. I got my Excel spreadsheet. I got all this technology, and I got this and this. Yeah, but if you don't have the experience, then and the experience can be brought along. It can be a partner. It can be someone a little bit older. And I think that's really important.
That's instilled at Matthews. There is a mentorship program within our firm, that if you're coming in and you go through the university process, that you actually are teams with an older producer or advisor or banker or whomever, to kind of show you the ropes and bounce ideas off of. So that we're very collaborative that way. And it happens in every office within Matthews. And I think that's part of the nuance here and attractiveness, is that you do have access to people who've been through cycles and understand the hardships and have been knocked down. But they also know how to, think long-term and think structure and explain how the real world works on the credit side or non-credit side or agency and so forth. So I think Matthews offers that to people who want to be in this field for sure.
Well, I'm certainly impressed. Every interaction I've had with Matthews. I don't want to finish without one last aspect of what you touch in your life, because I think it's really important. We live in this world where it's very easy to get consumed with our business, consumed with our kids, but that idea of giving back, being a person for others, you've been very passionate about a cause. And I got to tell you, young people, if you want a mentor, the best thing you can do is find someone you look up to and get involved in things they're involved with philanthropics. But anyway, I kind of talk about the charities that you started and the passion that you bring to veterans.
So I'm a board member for Los Angeles. Well, let me take that back. It's Idaho-based company, 501c3 entity called Higher Ground. And I belong to the LA chapter of Higher Ground Los Angeles, and we raise funds for veterans in need. Most of these veterans have severe PTSD, loss of limb, sexual trauma, and they don't have an outlet in terms of working through their issues other than going to the VA. And so what we bring to the table is outdoor activity within a unit-based platform, meaning when veterans are trying to heal, it's very difficult for them to do it on their own. And that's why you see such high suicide rates, I think, in this nation. Well, what we're trying to do is bring outdoor therapy to our veteran population through taking them surfing for a week, taking them rock climbing, Joshua Tree, Big Bear excursions, hiking, paragliding, horseback riding, etc. And what that allows them to do is to be around other veterans in a unit setting and talk about their issues and have them really come out and work through their issues. And I think it's been extremely successful, not only in Los Angeles, but in other chapters that are trying to open. And there's one in New York, and I think they're trying to create one in Dallas. So I put a lot of my time in trying to raise funds for Higher Ground Los Angeles, and it's been very gratifying for sure.
Terrific. Well, Geoff, it's been a great conversation. Love that I got you on the Real Market. Exciting to see how I think Matthews is one of the great young companies out there, and I'm glad they brought in a sage like yourself. And we'll talk soon, Geoff. Thanks for being on.
Thank you very much. Really appreciate the time.
Thanks.